Hello friends, welcome to the class of FTFM CS Final. In the last class of FTFM, the cost of capital chapter, we have discussed some questions on the basis of cost of capital and how to calculate weighted average cost of capital, how to calculate different cost of different components of cost of capital. Now we will continue with the questions, some further questions based on the cost of capital chapter. So in this chapter there are a lot of questions from Scanner and from other books, and in the last class I told you to purchase the scanner. You do purchase the scanner of CS Final, and today I'm taking two questions based on the cost of capital chapter, and then further few concepts based on the cost of capital chapter. And the question is from CS Final 2012 December. CS Final 2012 December. The capital structure of Supreme Limited is as under. The capital structure of Supreme Limited is as under. There are 2006% debentures, 2006% debentures of rupees 100 each. First issue, 6% debenture of rupees 100 each, and 1007% debenture of rupees 100 each. 1007% debenture of rupees 100 each. And the second issue, rupees 1 lakh rupees, 1007% debenture of rupees 100 each for second issue amounting to rupees 1 lakh. 2008% cumulative preference shares, 2008% cumulative preference shares of rupees 100 each amounting to rupees 2 lakh. 4,000 equity share of rupees 100 each amounting to rupees 4 lakh, and the retained earning amounting to rupees 1 lakh rupees. The retained earning amounting to rupees 1 lakh, and the total capital of the company, the total capital structure of the company consists of 6% debentures of rupees 2 lakh, 7% debentures of rupees 1 lakh, 8% cumulative preference shares of rupees 2 lakh, and 4,000 equity share of rupees 4 lakh, and retained earning amounting to rupees 1 lakh. Retained earning basically means the reserves, the general reserves and any other reserves includes in retained earnings. The earning per share of the company in the past many years has been rupees 15. The earning per share of the company, in the past few years has been rupees 15. The earning per share of the company is rupees 15, and shares of the company are sold in the market at book value. Shares of the company are sold in the market at book value. The shares of the company are sold in the market at book value. The company's tax rate is 30%, and shareholders' personal tax liability is 10%. So in the first question from 2012 December, I need to calculate weighted average cost of capital based on this information. And the other question from 2014 June, Priyanka Corporation has financial structure of 30% debt and 70% equity. Priyanka Financial Corporation borrows money 30% from debt and 70% from equity. The company is considering various investment proposals. Costing less than rupees 30 lakhs. The company wants to undertake various proposals for investment less than rupees 30 lakhs. The corporation does not want to disturb its present capital structure. The cost of raising the debt and equity are as follows. If the project cost is up to rupees 5 lakh, then the cost of debt will be 9% and the cost of equity will be 13%. And if the project cost is above 5 lakh and up to 20 lakh, then the cost of debt would be 10% and the cost of equity would be 14%. And if the project cost is about 20 lakh and up to rupees 40 lakh, in that case the cost of debt would be 11% and the cost of equity would be 15%. If the tax rate is 30%, you are required to calculate the cost of capital of two projects A and B whose funds requirements are rupees 8 lakh. The cost of capital, the project cost of project A is rupees 8 lakh and for project B is rupees 21 lakh respectively. So first of all, please do copy these questions and then tell you one by one the solution of these questions. So the solution of first question, the capital structure of a company is as under the cost of, I have to calculate the cost of debt, the cost of debenture, the cost of preference share, the cost of equity and the cost of retained earning. And one more information is provided in the question, the cost of the market price of equity shares. Market price of equity share is rupees 125 is also given in the question. So first of all, to calculate the cost of debt 1, I1 minus T divided by P, 6%, 1 minus tax rate is 30%, P stands for flotation price or market price or face value. The flotation price is not given, the market price is also not given of debentures, and in that case the face value 70, 4.20%. 4.20% is the cost of debt 1. Number 2, the cost of debt 2. I1 minus T divided by P. I1 minus T divided by P. I stands for interest rate, 7%. Tax rate 30%. That is 4.90%. Cost of debt 2. Cost of debt 2, 4.90%. Number 3, the cost of preference shares, the KP. The cost of preference share D plus CDT divided by P. D means dividend. Dividend is 8% of 100, means 8. CDT is 0. P stands for flotation price not given, market price not given. Face value 100. that is 8%. So the cost of debt 1 amounts to 4.20%. The cost of debt 2, 4.90%. The cost of cumulative preference shares, 8%. So these three components, the first three components of the cost of debt 1 amounts to rises 4.20%, the cost of debt 2 4.90%, the cost of preference shares 8%. So first of all, please note down these 3 points. So the first 3 points, fourth point, the cost of equity D1 divided by P plus G. D means dividend is not given, but the earning is rupees 15 per share. P means flotation price not given, market price of equity share 125. G stands for growth rate is also not given. 15 divided by 125. 15 divided by 125. 0.12, that is 12%. The cost of equity is equals to D1 divided by P plus G. D1 means next expected dividend is not given, but the earning per share rupees 15, and the growth rate is also not given. So the 15 rupees can be taken as the next expected dividend, and the value of market price of equity share is 125. The growth rate is not given. So 15 divided by 25 is equals to 12%. And the cost of reserves. The cost of reserves. The cost of reserves is equals to same the cost of equity, but the shareholders' personal tax liability is 10%. Shareholders' personal tax liability is 10%. So 15 rupees is the earning. The tax rate is 10%. Market price 125. 13.50 divided by 125. 0.108, that is 10.80%. The market price is given in the question is 125, but if the market price is not given, then we calculate the market price. So the market value of equity can be taken as the sum of the equity and the sum of retained earning. So the market value of equity is rupees 5 lakh, and the number of equity shares 4,000. So the market value of equity can be calculated as 120. If the market value of equity is not given in the question, then the total value of equity will be the sum of equity and retained earning. 4 lakh rupees plus the amount of retained earning is 1 lakh, 4 lakh plus 1 lakh, 5 lakh, divided by number of equity shares. The number of equity share 4,000 So 5 lakh divided by 4,000 is equals to 125. So the cost of equity as we calculated amounts to 12% and the cost of retained earning amounts to 10.80% after deducting the shareholders' personal tax liability of 10%. So first of all, please note down these 2 points. So the weighted average cost of capital particulars KA, K stands for cost, A stands for amount. The first component is 2006% debentures. The amount is rupees 2 lakh. The second component 1007% debentures of rupees 1 lakh. (2008% preference share of rupees 2 lakh, 4,000 equity shares of rupees 4 lakh, retained earnings of rupees 1 lakh. So the cost, the value, the cost of 6% debentures as we calculated 4.2%, 7%, 0.490%, preference shares 8%, equity 12%, 2 lakh multiplied by 0.0420, 8400 rupees, 1 lakh multiplied by 0.490, 4900, 2 lakh multiplied by 8%, 4 lakh multiplied by 12%, and 1 lakh multiplied by 0.1080, 10,800. The total sigma KA the weighted average cost of capital sigma KA divided by sigma A, 8400 rupees, 8400 rupees plus 4900 rupees plus 16,000 rupees plus 48,000 rupees plus 10,800, 88,100, 88,100 divided by 10 lakh, 0.0881, 8.81%. the weighted average cost of capital in this case, amounted, as we calculated, 8.81%. The weighted average cost of capital in this case is 8.81%. So please note down this portion of the solution. So the second question from 2014 June examination, Priyanka Corporation has a financial structure of 30% debt. The amount of funding 30% from debt and 70% from equity. 30% from debt and 70% from equity. 30% from debt and 70% from equity. Considering various investment proposals costing less than rupees 30 lakh. The corporation does not want to disturb its present capital structure. The cost of raising the capital, the debt and equity are as follows. If the project cost is up to rupees 5 lakh, then the cost of debt is 9% and the cost of equity will be 13%. Above 5 lakh, if the project cost is above 5 lakh but up to 20 lakh, then cost of debt would be 10% and the cost of equity would be 14%. About 20 lakh and 40 lakh and about 20 lakh and up to 40 lakh, the cost of debt is 13%, 11% and the cost of equity 15%. The tax rate is 30%. You are required to calculate cost of capital of two projects. A and B, whose funds requirement are rupees 8 lakh and 21 lakh respectively. Whose fund requirement are rupees 8 lakh and 21 lakh respectively. The fund requirement 8 lakh and 21 lakh respectively. So, the project A, in project A, the fund requirement is 8 lakh rupees and in project B, the fund requirement is 21 lakh rupees. In project A, the fund requirement is rupees 8 lakh. So, for project A, the funds requirement is rupees 8 lakhs. In project A, the fund requirement is rupees 8 lakh. And as given in the question, 30% amount borrowed from debt and 70% amount borrowed from equity. 30% from debt and 70% from equity. So out of 8 lakh rupees, 30% is the amount of debt and 70% is the amount of equity. 30% is the amount of debt and 70% is the amount of equity. So 30% of 8 lakh. 30% of 8 lakh, because the project requirement, the fund requirement is rupees 8 lakh for project A, 2.40 lakhs. And 70% of 8 lakh, 70% of 8 lakh, 5.60 lakhs. 5.60 lakhs. So, for the project A, the total fund requirement is rupees 8 lakh. The total fund requirement is rupees 8 lakh. The amount of debt is 30% of 8 lakh amounts to 2.40 lakhs and 70% is the amount of equity. 70% of 8 lakh amounts to 5.60 lakh. 70% of 8 lakh amounts to 5.60 lakh. 5.60 lakhs. So the fund requirement is rupees 8 lakh. And if the fund requirement is in between 5 to 20 lakh, if the fund requirement is between 5 to 20 lakh, then the cost of debt would be 10% and the cost of equity would be 14%. Cost of debt 10%, cost of equity 14%. So the cost of debt is equals to 10% and the cost of equity is 14%, and weighted average cost of capital, cost of debt into weight of debt plus cost of equity into weight of equity. The weighted average cost of capital, you are required to calculate the cost of capital of two projects. So for the purpose of computation of weighted average cost of capital, the weighted average cost of capital is equals to KD cost of debt into weight of debt plus cost of equity into weight of equity. The cost of debt is 10%. The weight of debt is 30%, means 0.30. The other way to calculate the weight, the same 2.40 lakh is the amount of debt out of 8 lakh, the same result 30%, and 5.60 lakh out of 8 lakh is the amount of equity 0.70. So the cost of equity is 14% and the weight of equity is 70%. So 0.30 0.03 plus 0.14 into 0.03 plus 0.128, that is 12.80%. 12.80%. So the cost of capital, the weighted average cost of capital of project A amounts to 12.80%. The weighted average cost of capital, the combined weighted average cost of capital of project A, the fund requirements in project A was 8 lakh rupees. So as per the fund requirement, the cost of debt is 10%, lies between 5 lakh and 20 lakh, and the cost of equity is 14%. And as per the information, the weighted average cost of capital in this case amounts to 12.80%. 12.80%. So first of all, please note down the solution of project A, the weighted average cost of capital of project A. There is one information, the cost of debt is basically, if nothing is given, it should be taken as pre-tax. So the cost of debt is 10% and after tax, the cost of debt would be 10 minus tax percent, tax rate is 30%. So 7% can be taken as cost of debt. 0.07 multiplied by 0.021, because if the cost of debt against the cost of debt nothing is given, it can be taken as pre-tax cost of debt because the tax rate is given. If the cost of debt provided in the question after tax, then there will be no problem, but it is basically the pre-tax cost of debt. So I have to calculate the after tax cost of debt amounts to 7%, 10% into 1 minus tax rate is 30%, tax rate is 30%. So the cost of debt 0.201 0.021 plus 0.098 11.9%. 11.9% is basically the weighted average cost of capital for project A. So for the project B, for project B, the total funds requirement for project B, the total fund requirement for project B, the total fund requirement $21 lakhs. Out of 21 lakhs, 30% from debt and 70% from equity. So 30% of 21 lakh, 6.30 lakhs, 70% of 21 lakh, 21 minus 6.3, 14.70 lakhs. So if the fund requirement is more than 20 lakh and less than 40 lakh, then the cost of debt, pre-tax cost of debt would be 11% and the cost of equity would be 15%. The cost of equity would be 15%. So I have to calculate the cost of debt after tax. Post-tax cost of debt, the 11% is the cost of pre-tax debt, 30% is the tax rate, 11 into 0.70. 7.70% and the cost of equity is basically in this slab the cost of equity is basically 15%. The cost of debt is 11% and the cost of equity is 15% in this slab. And weighted average cost of capital and weighted average cost of capital, cost of debt into weight of debt plus cost of equity into weight of equity. So the cost of debt is 7.7%. The weight of debt is 30%. The cost of equity is 15%. The weight of equity is 70%. .1050.0231 plus 0.1050 0.1281, that is 12.81%. 12.81% is the weighted average cost of capital, the weighted average cost of capital of project B. So the weighted average cost of capital of project B amounts to 12.81%. So please note down this portion. So I'm taking one more question from 2014 June examination. CS Final 2014 June examination. Monoplast Company Limited has the following capital structure. Monoplast Company Limited has the following capital structure. Has the following capital structure on 31st March 2013. The question from 2014 June examination, 4 marks type. Monoplast Company Limited has the following capital structure on 31st March 2013. The equity shares of the company, 4 lakh equity shares amounting to rupees 80 lakh. 4 lakh equity share amounting to rupees 80 lakh. 10% preference shares. 10% preference shares amounting to rupees 20 lakhs, 14% debentures amounting to rupees 60 lakhs, 1 crore 60 lakh is the total capital structure. Monoplast Company Limited has the following capital structure as on 31st March 2013. The equity share capital, the 4 lakh equity share amounting to rupees 80 lakh, 10% preference shares of rupees 20 lakh and 14% debenture of rupees 60 lakh. The total capital of the company 1 crore 60 lakh, and the tax rate share of the company sells for rupees. The market price of share is equals to rupees 20. The market price of a share is rupees 20. It is expected that the company will pay next year a dividend of rupees 2 per share. The next expected dividend is rupees 2 per share. It is expected that the company will pay a dividend of rupees 2 per share. Means the next expected dividend is rupees 2 per share and which will grow at 7% forever. The growth rate is 7% and the tax rate is 30%. So compute weighted average cost of capital. Compute weighted average cost of capital, WACC, compute weighted average cost of capital of Monoplast Company Limited. So for the purpose of computation of weighted average cost of capital, I have to calculate number 1, the cost of equity. Computation of cost of capital, number 1, the cost of equity. The cost of equity is equals to D1 divided by P plus G. D1 basically means next expected dividend. P stands for flotation price or market price or face value. G stands for growth rate. So D1 is rupees 2. P stands for flotation price or market price 20. The growth rate is 7%. 0.17, that is 17%. The growth rate is 17%. The growth rate is 7%, but the cost of equity, as we calculated, 17% is basically the cost of equity. 17% is basically the cost of equity. So the cost of equity is equals to D1 divided by P plus G. The value of D1 is 2. The next expected dividend is rupees 2 per share. The market price, the flotation price is not given, so the second preference is market price. Market price is 20 per share and the growth rate as provided in the question is 7%. 7% is basically the growth rate. So 2 divided by 20, 10% plus the growth rate 0.07 is equals to 17%. Second part of the question, I need to calculate cost of preference shares. The cost of preference shares, D plus CDT, divided by P. D stands for dividend, CDT corporate dividend tax, P stands for flotation price or market price or face value. KP, D plus CDT divided by P. D stands for dividend. Dividend is 10% of the face value. The face value is not given. If the face value is not given, the face value can be taken as 100. The face value can be taken as 100. So the face value is rupees 100. The dividend is 10% of 100. The dividend is 10% of 100. The corporate dividend tax is P stands for flotation price or market price or face value. Flotation price is not given. Market price is also not given in the question. So the face value can be taken as the value of P, rupees 100. 10 divided by 100, 0.10, that is 10%. That is 10%. The third part, I need to calculate the cost of debt. No information regarding redemption of debenture. No information regarding redemption of debenture is provided in the question. So, the debt can be taken as irredeemable debt, means non-redeemable debt. The cost of non-redeemable debt is equals to I1 minus T divided by P. I stands for interest rate on the face value. Face value is rupees 100. So 14% of 100. 14% of 100. 1 minus tax rate is 30%. P stands for flotation price or market price or face value. Flotation price भी नहीं दिया, market price is also not given, so the face value of rupees 100, 14% of 100, 14 into 0.701 minus 0.30 divided by 100, 9.80 divided by 100, that is 9.80%. 9.80% is basically the cost of debt. 9.8% is basically the cost of debt. So there are three components in the capital structure of Monoplast Company Limited. The first component is equity share capital. The second component is 10% preference share capital. The third component is 14% debentures. So the respective cost of equity share capital as you calculated comes to 17%, the cost of preference shares 10% and the cost of debt 9.80%. So first of all, please note down these 3 points, then I will calculate the weighted average cost of capital. So the computation of weighted average cost of capital. Particulars. K stands for cost, A stands for amount, K into A. The first component is basically equity shares. The second component 10%. The third component 14% debentures. The value of equity shares is 80 lakh rupees. The value of preference shares is rupees 20 lakh. The value of debenture is rupees 60 lakh. The respective cost as we calculated, the cost of equity as we calculated amounts to 17%. In first step, the cost of preference shares amounts to 10%. The cost of debt amounts to 9.8%. So 80 lakh multiplied by 0.17, 13,60,000. 20 lakhs multiplied by 10, 2 lakh rupees. 60 lakh multiplied by 60 lakh multiplied by 0.0980, 5,88,000. One crore 60 lakh is the total amount of capital. 1 lakh 13,60,000 plus 2 lakh 15,60,000 plus 5,88,000. 15,60,000 plus 5,88,000, 21,48,000. 21,48,000. So the weighted average cost of capital sigma KA divided by sigma A, 21,48,000 divided by 1 crore 60 lakh. 21,48,000 divided by 0.13425, that is 13.43%. 13.43% is weighted average cost of capital of Monoplast Company Limited, consisting the capital structure of Monoplast consisting of equity share capital of rupees 80 lakh, preference share capital of rupees 20 lakh, 14% debentures of rupees 60 lakh. So the final balance, the cost of capital, the cost of equity as we calculated amounting to 17%, the cost of preference shares 10%, the cost of debenture 9.8%. So on the basis of cost of equity, cost of preference shares and the cost of debenture, the weighted average cost of capital of Monoplast Company Limited amounts to 13.43%, the weighted average cost of capital of Monoplast Company Limited. So these three questions based on the cost of capital chapter. Some more questions we'll do in the next class. आज के लिए इतना ही. Goodbye. Take care. All the best.